Today, I want to talk about how the shorts have suffered massive losses, not just in 2022, but in 2023 as well, and especially over the last week. Some shorts out there have lost hundreds of billions of dollars. So stay tuned and let's make some money. Now I'll dive straight in with the key information. So, StockSense Frank tweeted saying hedge funds were down a combined $208 billion in 2022, the biggest loss since 2008. And he said the report cites research by LCH Investments, a fund of funds firm that tracks returns and is part of the Edmund Rothschild Group, as showing that the overall losses came despite some firms chalking up bumper gains. So that's basically saying the net loss in the hedge fund industry was $208 billion. If you remove some of those hedge funds that generated profits, I wonder just how large that loss would be. Would it be 300 billion, 350 billion, 400 billion, or maybe even more? Many funds in 2022, including Tiger Global Management and Point72, struggled as global markets slumped. But as I said, it's not just 2022. Many of these hedge funds are still taking on losses in 2023. He said hedge fund losers in 2023 have been significant for some of the star traders who performed well in 2022. For example, Saeed Haidar, who generated 193% in 2022, lost 32% of his fund in March 2023 alone, and 44% year to date. Pierre gained 59% in 2022 but lost 23% in March as well and 40% year to date. Chris and Adam also lost 15% in March and 25% in March, and Adam even shut down his hedge fund. And he said some of the factors that contributed to these massive losses in 2022 and 2023 include the collapse of Silicon Valley Bank, which triggered a liquidity crisis in the banking sector and forced some hedge funds to unwind their positions at a loss. It's also been caused by the uncertainty and volatility in the bond markets, and the 2022 rise of inflation, and the 2023 increase in interest rates. And as you can see, some of these funds are still taking on losses last week especially, as PG tweeted saying hedge funds caught in crowded trades suffered in Thursday's stock rally. That basically means that as a result of Thursday's stock rally, many hedge funds that were shorting crowded shorts, aka those shorts in Affirm, Upstart, Coinbase, Carvana and others, suffered massively last week. The article says that global hedge funds using algorithms to trade stocks endured one of their worst days of the year on Thursday, a sign that a sharp rally in shares on hopes that global rate hikes are over caught some off guard. Saying systematic fund managers, particularly those who had short bets on highly traded stock names, got caught trying to get out of crowded trades and found themselves stuck in losing positions. This is actually something I've spoken about in the Millionaire Mindset Trading Group, because as you can see, the S&P 500 looks to be breaking out of that downward trend. Over the last couple of months since July, which was when AMC's cost to borrow was at its highest, the S&P 500 has been trending downwards. Obviously, when the market falls, many stocks in the market fall as well, perfect for the shorts to recoup some of their losses. But over the last week, the S&P 500 has risen more than 6% and has seemingly broken out of that downtrend. And if this downtrend has broken and this upward trend continues, that's going to spell bad news for those short sellers, especially short sellers in those heavily shorted names like Upstart, Affirm, Carvana, Coinbase and others. As I've previously said, when these shorts are stressed, they start closing out shorts firstly in large tech stocks like Nvidia, Tesla, Microsoft and others. Then if they're still stressed, they close shorts in heavily shorted names like Carvana, Upstart, Affirm, Coinbase and others, before finally closing their meme stock shorts. These meme stock shorts are the largest and the most risky. These hedge funds don't want to have to close out of those short positions because they know that doing so would not only bankrupt their hedge fund, but maybe bankrupt the entire hedge fund industry, or at least specifically cause a stock market crash. Closing out of those AMC and GameStop shorts would cause the short squeeze, especially if those synthetic shorts are closed out of as well. And doing so could end up bankrupting a market maker, or at least a hedge fund who has significant meme stock short exposure. And doing so could end up toppling the wider stock market if their losses are significant and the Fed is required to be involved. Stefan also tweeted saying, "I must admit, I was rather skeptic to Dr. Metzler's predictions in 2021 regarding Evergrande's default." He said, but he was right. 3 months ago, Evergrande filed for Chapter 15 bankruptcy. As a result, this article was recently released saying Marco Metzler insisted that China's Evergrande was bankrupt in 2021, and now his critics have been silenced. That article was written August 24th, 2023, just over 2 months ago. But you may also remember that his original prediction on December 6th, 2021 is not only that Evergrande would crash, but he also told you to buy GameStop and AMC. So Stefan has said that he's now convinced that Marco Metzler's predictions for AMC and GameStop were right. He said, just have patience. If Marco Metzler was right about Evergrande and how they were bankrupt and we're always going to go bankrupt, maybe he's right about AMC and GameStop too. And he wouldn't be the only analyst to predict the AMC and GameStop squeezes, but the majority of analysts and their predictions get covered by the mainstream media and their regular spreading of FUD. Now you may remember this morning we went through our options play of the day from the Millionaire Mindset trading group, but today we had an absolute banger of a day, also having a fast moving momentum news play of the day as well. LIFW or MSP recovery started running in the early hours of the market open. It then had a pullback and set a daily high of $4.65. It then broke upwards out of that $4.65 region and ran to new highs of $9.40. And I also said that LIFW wasn't done here, and a break of that $9.40 region would push the stock higher, which it did to daily highs of $16.50. If you got in for the break of $4.65, that would have been a whopping 255% gain. If you got in for that second run up, the break of $9.40, that's still a whopping 75% gain in just one singular day. And if you want to be making daily gains like this, be sure to join the Millionaire Mindset trading group linked in the description below. And you may have also seen that a former top executive of an investment fund has just admitted to a $294 million securities fraud conspiracy. It says a former co-founder and top executive of an investment fund pleaded guilty today for conspiring to defraud dozens of victim investors out of $294 million in funds. It says John Hughes admitted today that he orchestrated a complex and sophisticated scheme to bilk investors of their hard-earned money. And it also says as the losses mounted, he engaged in a cover-up, trying to conceal the staggering fraud. So it's interesting, and it goes to show that losses can actually be covered up and hidden until it all starts to unravel. Maybe that's what many of these funds, short sellers, institutions and market makers are doing. Maybe they're trying to cook the books, cover up those losses, and hope that their entire web of lies doesn't come to fruition and doesn't unravel. And on that same line, Charles Payne tweeted saying this was no lemonade stand, referring to FTX. He asked, who designed a company to take in 1.2 million customers and steal $9 billion in broad daylight while being feted by the financial media and buying Congress? And he said, hint, not Sam Bankman-Fried. This is the entire group structure for FTX between the various directors and shareholders. Each one of these little boxes is a separate entity and a separate company in a different country. You can see this massive web of companies going onshore, offshore, back onshore. All these companies are interlinked by the various directors, and everything here is very, very confusing. This complex group structure has obviously been set up by an accounting firm, and Charles Payne believes Sam Bankman-Fried wasn't ever at the helm. He believes there was somebody much more intelligent running this giant fraud. And he's also said to stop showering Sam Bankman-Fried and his family with sympathy, saying it's time to expand the probe to everyone involved, including Wall Street and Silicon Valley. This is really, really interesting, and it's something I've hinted at for a while now. I've said Sam Bankman-Fried wasn't the ultimate conspirator, and there was someone above him giving him orders and giving him direction. Maybe it was Ken Griffin, maybe it was somebody else, but I do really believe there is someone for Sam Bankman-Fried to snitch on. I've said before that it may be Ken Griffin and Citadel Securities because of the links between FTX and Citadel, and also because of the varying similarities between FTX's group structure or their entities and Citadel's group structure and entities too. They were both market makers, they were both hedge funds, they both ran their own trading platforms and crypto dark markets, or stock dark markets as well. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.